You ever watch someone order a $7 latte every single morning while complaining they can't afford to invest? Yeah, same people who will binge an entire Netflix series in one night, but don't have time to learn where their money's going. It's wild. Folks will put more research into which air fryer to buy than into what's happening with their retirement savings. And then they're shocked when their gut feeling stock pick crashes harder than their New Year's gym goals. If that stung a little, good. That's the point. Because the truth is, most people aren't investors. They're speculators wearing an investor costume. And just like wearing scrubs doesn't make you a doctor, buying stocks doesn't make you an investor. Today, we're talking about one of the most important finance books ever written, The Intelligent Investor by Benjamin Graham. And before you think this is another just put your money in index funds and hope kind of talk, buckle up. Graham isn't here to coddle you. He's here to hand you a mirror, show you your bad habits, and dare you to change. Now, Benjamin Graham, born in 1894, raised in the streets of financial chaos, wasn't just some professor scribbling theories on a chalkboard. He was a man who lived through market booms, busts, and the Great Depression, and came out the other side with a philosophy that turned investing from superstition into a discipline. He mentored Warren Buffett, for crying out loud, the guy who literally calls this book the best on investing ever written. Main theme: Graham's mission is to separate investing from gambling and teach you to approach the market with logic, discipline, and a cold-blooded refusal to follow the herd. He's not here to tell you how to get rich quick. He's here to show you how not to go broke slow. Disclaimer: this video falls under the Fair Use Act. It's for educational purposes only. We're taking Graham's core ideas and giving them new meaning, new commentary, and modern context. If you want the full original text, and you should, buy the book. Seriously. Don't be that person who spends $200 on dinner but won't drop $15 to improve their financial brain. Why this matters today? We live in a time where the line between investing and gambling has been obliterated. Meme stocks, crypto moonshots, TikTok finance gurus telling you to put your rent money into whatever's trending. And you know what's scarier? People are listening. Graham's lessons are more relevant than ever because most investors' worst enemy isn't the market, it's themselves. Welcome to Mindful Reads Hub. Let's get started. The game of money, drawing the line between investing and gambling. Most people walk into the stock market like they're strolling into Vegas with a lucky feeling. They'll tell you they're investing, but the truth, they're gambling with better lighting. And here's the problem. When you confuse investing with gambling, you don't just lose your money, you lose the very mindset that could have made you wealthy. Before you put $1 into the market, you have to know whether you're playing chess or roulette. Benjamin Graham starts by hitting you with the first uncomfortable truth. This isn't a get-rich-quick book. If you came here looking for a free stocks to buy now cheat code, you're already on the wrong battlefield. Investing is not about secret stock picks. It's about building a framework that keeps you from making the kind of stupid emotional decisions that tank portfolios. And that's where most people fail. See, Graham splits the world into two camps: investors and speculators. Investors do analysis, demand safety of principle, and aim for adequate returns. Speculators, they're the ones buying because it's been going up or selling because it's been going down. In other words, they're chasing the market like a bad Tinder relationship, running after it when it's hot, dumping it when it cools off, and then they wonder why they never win. What's wild is how this definition flipped over time. Back in the 1930s, all stocks were seen as speculative, even blue chips. After the Depression, common stocks were treated like dangerous snakes. Fast forward to the bull markets of the 50s and 60s, and suddenly everything was called an investment. Didn't matter if it was a stable business or a junk company, the label was slapped on just because prices were going up, and that's how people got crushed. Here's where the commentary comes in. This isn't just a 20th century problem. Today, half the internet thinks buying into a meme coin is investing for the future. We've got Robinhood traders calling themselves long-term investors, while day trading options on their lunch break. Graham would have called this what it is, pure speculation, and there's nothing inherently wrong with speculating. It's like ordering dessert, but you don't make it your whole meal and expect to survive. For Graham, if you must speculate, you put a small, clearly defined chunk of money into a separate account, treat it like it's already gone, and never mix it with your real investments. But most people don't have the discipline for that. They keep doubling down when they're ahead, then panic sell when they're behind. They're playing musical chairs with their own retirement fund. And here's another slap of reality. There's no such thing anymore as a purely safe common stock. Every stock carries some speculative risk, no matter how big or stable the company. Your job is to keep that speculative element small and manageable, and to be emotionally and financially ready for downturns that might last longer than your patience. That's where the defensive versus enterprising mindset comes in. The defensive type values safety and minimal effort. They're building wealth slow, steady, and boring. The enterprising type, they put in the hours, research deeper, and hunt for better than average opportunities. But even they have to avoid the traps of overconfidence and market hype. The game of money rewards discipline, not IQ points. High intelligence won't save you if you can't control your impulses. Look at Isaac Newton, genius of physics, terrible at resisting a stock bubble. He made a fortune, cashed out, then got sucked back in at the peak and lost way more than he'd made. Smart people can do incredibly stupid things when greed and fear take the wheel. And that's why Graham keeps coming back to one principle: measure everything. Don't buy a stock like you're buying perfume, buying it just because you like the brand. Buy it like you're buying groceries. Compare prices, check the quality, and ask yourself if it's worth the cost. That one habit, knowing exactly how much you're paying for what you're getting, would have saved countless investors from disaster. If you take nothing else from this section, take this. Your worst enemy in investing is not the market, the economy, or even the Fed. It's you, your emotions, your lack of patience, your inability to separate gambling from investing. Master that, and you can survive, and even thrive, in any market. Fail, and you'll just be another cautionary tale your smarter friend tells over beers. Key takeaway: if you don't know whether you're investing or speculating, you're speculating. And the less you admit it, the more likely you are to lose. Favorite quote: the investor's chief problem, and even his worst enemy, is likely to be himself. The invisible thief, inflation and the investor's blind spot. Inflation is like that friend who always forgets their wallet at dinner. They never make a scene, they just slowly drain you over time, and by the time you realize what's happened, you're broke, resentful, and wondering how you didn't see it sooner. Graham doesn't romanticize it, he calls it what it is: a permanent, silent tax on your money. It doesn't care if you're rich, poor, defensive, enterprising, or just starting out. If you hold cash or anything that pretends to be safe without thinking about its purchasing power, you're basically volunteering to get robbed. The cruel trick is that inflation rarely feels like robbery in real time. Prices creep up slowly. Your $100 buys a little less here, a little less there. You still feel like you have the same lifestyle, but the edges start to fray. The brand you used to buy becomes a special treat. The vacation gets pushed to next year. The house you wanted is suddenly out of range. Meanwhile, if you're sitting in fixed income investments, thinking you've played it safe, you're getting destroyed in slow motion. Your so-called safety net is shrinking every day. Graham's blunt message: if you're not factoring inflation into every investment decision, you're living in a fantasy. This is where history kicks you in the teeth. Look back a century and you'll see the same cycle over and over. Booms, busts, recoveries, crashes, recoveries again. People act like this time is different, but Graham's charts make it obvious. Human behavior doesn't evolve, it just finds new costumes. After the 1929 crash, everyone swore they'd learned their lesson. By the late 1960s, they were right back in the same overconfident, over-leveraged mess, and when the correction came, they were shocked. Inflation just adds a layer of pain to the inevitable correction. When you lose money to a market drop and your dollars are worth less at the same time, you're getting punched in the face and robbed while you're on the ground. The trap is that both amateurs and professionals love to tell themselves they'll dodge the next big downturn. Graham rips that fantasy apart. The data says otherwise. Most people not only fail to dodge, they accelerate straight into the wreck by buying high and selling low. The smart move isn't to time the market perfectly, it's to structure your portfolio so inflation can't bleed it dry no matter what the market is doing. That means understanding the difference between assets that actually protect purchasing power and assets that only look good on paper until the cost of living rises. Here's the part no one wants to hear. Stocks aren't a guaranteed inflation hedge either. Yes, over decades, equities have historically outpaced inflation, but there are long stretches where they don't. If you happen to retire or need cash during one of those stretches, you're done. Bonds? Even worse. Fixed interest means fixed purchasing power erosion. Cash? That's just pre-digested inflation food. You think it's safe because the number in your bank account doesn't change, until you try to spend it. Graham's solution isn't sexy. Diversify. Keep a balance between stocks and bonds that reflects reality, not optimism, and adjust as conditions change. Not because you're timing the market, but because you're defending against the two enemies that never go away: volatility and inflation. And don't get cocky about spotting the turning points in market history. Even with perfect hindsight, it's easy to forget that in real time, the signs were messy, contradictory, and drowned out by noise. The people who survive aren't the ones who called the top or bottom. They're the ones who never let themselves get so exposed that a bad turn wipes them out. Inflation makes the stakes higher because it turns every year you stand still into a loss. It's like running on a treadmill that slowly speeds up. Stand still and you fall. This isn't fear-mongering, it's math. Your return isn't the number you see in your brokerage account. It's that number minus inflation, minus taxes, minus your own bad decisions. Ignore any of those, and the game is over before you realize you're losing. Graham's investors think in real terms, not nominal ones. They don't celebrate a 5% gain when inflation is 6%. They don't fall for safe assets that quietly rot away. They keep their eyes on purchasing power because that's the only scoreboard that matters. Key takeaway: inflation is the constant background enemy of wealth. If your investments aren't outpacing it, you're not just standing still, you're moving backwards. And the market's history proves most people won't realize it until it's too late. Favorite quote: "The investor's chief problem, and even his worst enemy, is likely to be himself." Two roads to wealth: defensive versus enterprising portfolios. Most people think the road to wealth is about finding the one stock, the one market tip, the one perfect moment to go all in. They approach investing like they're waiting for some magical opportunity that will make them rich overnight. Graham tears that fairy tale apart. Wealth, he says, isn't a lottery ticket you scratch and hope for a jackpot. It's a strategy you choose. And there are two main strategies that actually work. One plays it safe, the other takes the scenic, riskier route. Both can make you rich, but only if you stick to the rules and stop trying to mix the two like some kind of financial cocktail. The first path is for the defensive investor. This is the person who doesn't want to think about their portfolio every day, who values safety over excitement, who's willing to sacrifice the "I doubled my money in 6 months" of stories for the quiet satisfaction of steady, predictable growth. Graham doesn't romanticize it. It's boring, and that's the point. Your goal here isn't to be impressive, it's to be unshakable. This means holding a balanced mix of high-grade bonds and quality stocks, usually somewhere between 25/75 and 75/25, and adjusting only when the market moves far enough to throw you off balance. The defensive investor isn't trying to beat the market, they're trying to survive it. Then there's the enterprising investor, the one who's willing to dig, research, and work for better than average returns. This isn't about being reckless. It's about having the time, skill, and discipline to find opportunities others overlook. But Graham's blunt about this. Most people who think they're enterprising investors are just gamblers with internet access. The enterprising route isn't for the impatient, the undisciplined, or the people chasing hot tips. It's for those willing to put in consistent, methodical effort and accept that the payoff might take years, not weeks. Here's where modern reality kicks in. Most investors fall into a dangerous middle ground. They want the safety of the defensive path, but the returns of the enterprising one. So they do the worst possible thing. They stick 90% of their money in safe assets and then gamble the other 10% on the latest hype train, convincing themselves it's a smart speculative play. It's the financial equivalent of eating salad all week and then demolishing 2 pizzas on the weekend. You erase all your progress and then wonder why nothing changes. For the defensive type, Graham's rules are clear. Stick with big, conservatively financed companies with a history of paying dividends. Don't chase high growth rates. They rarely last. Buy at reasonable prices, not when the market's frothing at the mouth. Rebalance automatically, not emotionally. And if you can't bring yourself to follow those rules, admit you're not really defensive and stop lying to yourself about your risk tolerance. For the enterprising type, the homework is harder. This is about finding undervalued stocks, small companies with solid balance sheets, or special situations the broader market has ignored. It's about patience and conviction, buying when everyone else is looking away and holding while they figure out what you already saw. But the moment you get lazy, the market will remind you that it doesn't care about your intentions. An enterprising investor who stops doing the work isn't enterprising anymore. They're just another overconfident speculator waiting to be humbled. What's genius about Graham's approach is that he doesn't say one path is better. The right choice isn't about maximizing returns at all costs. It's about picking the strategy you can actually stick to when things get ugly. Because make no mistake, they will get ugly. If you're defensive, your worst enemy is boredom. You'll be tempted to spice things up right before a downturn. If you're enterprising, your worst enemy is arrogance. You'll be tempted to overreach just when discipline matters most. The painful truth is that most people fail not because they pick the wrong road, but because they keep switching roads every time traffic slows down. They abandon the steady climb for a shortcut that turns out to be a dead end. Graham's advice is brutal in its simplicity. Choose your road, commit to it, and stop trying to be someone you're not. Wealth is built by consistency, not by constantly reinventing yourself because you're scared you're missing out. Key takeaway: your success isn't about finding the best strategy. It's about choosing the strategy that matches your temperament and sticking to it long enough for it to work. Favorite quote: the determining trait of the enterprising investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Hunting for gold, the enterprising investor's secret weapons. There's a brutal truth most people can't handle. Not everyone is cut out to hunt for investment opportunities. Everyone thinks they are, because it's fun to picture yourself as the genius who spots the diamond in the rough before anyone else notices. But the reality? Most people can't even spot a fake Gucci bag, let alone an undervalued company. And that's why the enterprising approach isn't just about finding hidden gems. It's about knowing where not to dig in the first place. Graham calls this the negative approach, and it's the part of investing people hate because it sounds boring. But boring saves you from disaster. The negative approach is about eliminating the obvious losers before you go treasure hunting. That means avoiding companies with poor financial strength, erratic earnings, excessive debt, or stock prices pumped up by hype instead of fundamentals. In other words, you don't give them a chance because you feel lucky. You cross them off the list without hesitation. And here's the part modern investors ignore. Graham would rather you miss out on a winning gamble than get caught in one guaranteed loss. The internet has trained people to think every pullback is a buying opportunity and every underdog is a Cinderella story. It's not. Sometimes the pumpkin is just a pumpkin and your job is to leave it in the field. But once you've cleared the junk, you can flip to the positive side. The part people imagine when they think of the enterprising investor. This is where you look for companies with strong balance sheets, stable earnings, and stock prices that are lower than the company's actual value. This isn't guessing, it's math, patience, and a healthy disrespect for market moods. Graham's ideal candidates are often boring businesses that everyone else overlooks because they aren't making headlines. That's why you can get them cheap, and why they reward you when the hype fades elsewhere. Here's the kicker. Most people who call themselves value investors aren't doing this. They're chasing whatever's hot, slapping the value label on it because the PE ratio looks lower than the average, and then acting surprised when it tanks. Graham would laugh at how many value investors end up owning companies with collapsing revenues and broken business models because they thought the low price meant cheap. It doesn't. Sometimes it just means the market sees the iceberg you're pretending isn't there. Being enterprising isn't about being busier than everyone else. It's about being more selective. It's resisting the itch to do something just because you've got cash sitting there. It's understanding that the best opportunities don't show up every day, and when they do, you'll only recognize them if you've been doing the work all along, and it's absolutely about knowing your own limits. Graham is ruthless on this point. If you can't dedicate the time and mental energy to deep analysis, don't kid yourself. Go back to the defensive strategy and stop lighting money on fire trying to play in a league you're not trained for. The real edge isn't in taking massive risks or predicting the future. It's in having the discipline to stay out of trouble while everyone else is rushing into it. That's the paradox of the enterprising investor. You look bold from the outside, but most of your boldness comes from the courage to say no far more often than yes. You're not chasing everything that moves. You're hunting for the things that are worth holding even when the market calls you an idiot for buying them. And when you're right, time does the heavy lifting, not your ego. Key takeaway: success as an enterprising investor isn't about finding more opportunities. It's about rejecting the wrong ones and having the patience to wait for the right ones. Favorite quote: the essence of investment management is the management of risks, not the management of returns. Riding the storm, mastering market fluctuations. Most people think the market is a nice, steady elevator ride to the top. You put in your money, you wait a bit, and voila, wealth. Then reality slaps them so hard they forget what floor they're on. The market doesn't move like an elevator. It moves like a drunk on a unicycle, swerving, wobbling, occasionally face planting, and somehow still making progress over time. Benjamin Graham's genius wasn't in predicting exactly when the drunk would fall. It was in teaching you how not to get knocked down with him. Here's the part nobody likes to hear. Market fluctuations aren't a bug. They're the entire point. Without them, there's no way to buy low and sell high. No way to get bargains, no way to earn returns above the interest on a savings account. But the average investor treats every market drop like a personal insult and every market boom like a once-in-a-lifetime invitation to go all in. Graham's advice: stop acting like a manic depressive at a casino. The market is not your mood ring, and your portfolio shouldn't reflect your latest emotional state. This is where his famous Mr. Market analogy comes in. Imagine you have a business partner named Mr. Market. Every day he offers to buy your share or sell you his. Some days he's cheerful and quotes ridiculously high prices. Other days he's gloomy and throws out bargain basement offers. Your job is not to match his mood, it's to take advantage of it. When he's drunk on optimism, you sell. When he's hungover with pessimism, you buy. And when his price makes no sense at all, you ignore him and keep running your business. The tragedy? Most people are Mr. Market, but here's the twist. Graham didn't just want you to survive market swings, he wanted you to weaponize them. The best opportunities usually appear when everyone else is panicking. That's when prices are out of sync with reality, when solid companies are selling for less than their actual worth simply because people are too scared to think straight. If you can keep your head when the herd is stampeding, you get to shop at a discount while they're tripping over each other to sell at a loss. Then there's the matter of investing in funds. People love the idea of handing their money to professionals so they can avoid the stress of market timing. Sounds great until you realize most funds underperform the market over time, especially after fees. Graham's take: if you must go that route, pick low-cost, passively managed funds and stop expecting them to make you rich overnight. Your returns will be steady, boring, and unremarkable. Which, if you remember the defensive investor mindset, is exactly what you want. The problem is, people can't leave boring alone, so they keep switching funds the moment a different one looks shinier. That's not investing, that's speed dating with your retirement. The core lesson here is as confrontational as it is liberating. You are not required to react to every market move. In fact, reacting less is usually the key to doing better. The big returns come from patience, not from perfectly timing every zig and zag. Every time you jump in and out of the market chasing the last good idea you read on social media, you're paying tuition to the school of overconfidence, and the only diploma you'll get is a thinner wallet. If you want to ride the storm, you don't need a perfect forecast, you need a sturdy ship. That means a portfolio built on assets you believe in, bought at prices that give you a margin of safety, and held through whatever weather comes. Because storms will come, and if you abandon ship every time the waves get rough, you'll never make it to the shore. Graham's investors didn't just survive volatility, they profited from it because they understood that in the market, calm seas are for amateurs and the real money is made when the water's choppy and everyone else is heading for the lifeboats. Key takeaway: volatility isn't your enemy, your reaction to it is. The investors who win aren't the ones who avoid storms, they're the ones who learn to sail through them. Favorite quote: "The intelligent investor is a realist who sells to optimists and buys from pessimists." Allies and enemies, choosing the right financial guides. Some investors think hiring an advisor is like hiring a personal trainer. They'll do all the heavy lifting for you while you stroll around in a new tracksuit. The reality? Plenty of so-called experts are closer to carnival barkers than financial sages, yelling, "Step right up," while ushering you toward overpriced products you don't understand and they don't fully believe in. Benjamin Graham's point was brutally simple. Just because someone is in the financial industry doesn't mean they're working for you. Too many are working for the commission slip. The first problem is that most investors don't even know how to judge their advisors. They confuse confidence with competence, charm with insight. A warm smile and a slick pitch about once-in-a-lifetime opportunities can melt away any resistance, right up until your portfolio melts away too. Graham wanted investors to understand that a true advisor earns their keep by protecting you from bad decisions, not by dazzling you into risky ones. Think of them less like a flashy sports coach and more like an obsessive air traffic controller, someone whose real job is to keep you from colliding with disaster. Then comes the equally dangerous territory of self-advice. Investors who refuse outside help often overestimate their ability to analyze securities. It's like watching someone with a YouTube medical degree try to perform surgery. Sure, you can read balance sheets and earnings reports, but unless you know how to strip out the hype and dig into the reality, you're just slicing into numbers until you find what you want to see. Graham's version of security analysis was ruthless. Ignore market chatter, ignore short-term noise, and examine the company as if you were buying the entire business, not just a few shares. The confrontation here is unavoidable. If you're going to choose an advisor, choose one who's incentivized by your long-term success, not by the number of trades you make. If you're going to go solo, learn to be merciless in your analysis, because the market has zero interest in your feelings. The spreadsheet doesn't care that you like the company's logo. The cash flow statement doesn't care that your cousin works there. And the collapsing stock price doesn't care that you had a good feeling about it. And here's the kicker. Most bad advice doesn't come from malice, it comes from ignorance or misplaced confidence. That's why Graham's real warning wasn't just beware of crooks, it was beware of the well-meaning fool. Your financial life can be ruined just as easily by an advisor who doesn't know what they're doing as by one who's actively trying to rob you. The end result is the same. You're broke and they've moved on to the next client. So how do you armor yourself? Ask hard questions, demand proof of competence, check their track record in bad markets, not just good ones. If their plan for your money sounds like a magic trick, assume it's your wallet that's going to disappear. And if you're doing your own analysis, remember, the goal isn't to find reasons to buy, it's to find the truth about the value you're getting. That's not glamorous, and it won't impress anyone at dinner parties, but it's what keeps you from walking off the same cliff as everyone else chasing the next big thing. In the end, the market is a dangerous place, not because it's inherently rigged against you, but because it's full of people who will happily steer you into danger if it benefits them, or if they simply don't know any better. Graham's message was confrontational because it had to be, Stop outsourcing your judgment to people who don't have to live with the consequences of your losses. And if you insist on letting someone else steer the ship, at least make sure they know how to navigate storms. Key takeaway: the wrong advisor can cost you more than any market crash. The only guidance worth paying for is the kind that keeps you safe when it's hardest to be safe. Favorite quote: the investor's chief problem, and even his worst enemy, is likely to be himself. The numbers don't lie until they do. Reading earnings with X-ray vision. If you believe numbers can't lie, you've clearly never read an annual report crafted by a company desperate to look like the next Amazon. In theory, earnings per share should be the truth serum of investing, a simple metric telling you exactly how much profit each share represents. In practice, it's more like a magic trick where the magician smiles while hiding half the cards up his sleeve. Companies massage numbers the way reality TV producers edit footage, selectively enough to make even a disaster look glamorous. Graham's point is simple but brutal. You can't take reported earnings at face value unless you enjoy being the sucker at the poker table. The market is full of investors who treat EPS like gospel, as if the finance department was a monastery and the CFO a humble monk transcribing eternal truths. Wrong. Those earnings have been adjusted, normalized, seasonally smoothed, and often stripped of non-recurring expenses that somehow seem to recur every year. Graham's advice: treat every number as a suspect in an interrogation. Cross-check it against cash flow, long-term trends, and, most importantly, what management actually did, not what they said. It gets worse. Even when the numbers are technically accurate, they can still be misleading if you're not looking at them in context. A high EPS in a single year might be the result of selling a big chunk of assets, cutting critical staff, or slashing R&D, moves that can boost short-term profit while hollowing out the company's long-term future. Investors who only look at the headline figure are like people who judge a car solely by its paint job, oblivious to the fact that the engine is about to give out. That's why Graham insists on comparisons, not to see which company won a given quarter, but to spot patterns over years. Compare a business to its own past, compare it to competitors in the same industry, compare how its earnings behave in both bull and bear markets, and above all, compare the story the numbers tell to the reality of the company's operations. If they don't match, you've either found a turnaround in the making or a disaster waiting to happen. And here's where the confrontation gets personal. Most investors don't want the truth. They want confirmation. They cherry-pick numbers that make them feel smart, the same way someone on a diet will highlight the low-fat label on a tub of ice cream while ignoring the sugar content. The danger isn't just that companies distort earnings, it's that investors distort their own thinking to justify the investment they already want to make. Graham's method forces you to stop looking for excuses to buy and start looking for reasons you might be wrong. The market doesn't punish you for missing a great opportunity. It punishes you for walking blindfolded into a bad one. If you're willing to slow down, dig into the footnotes, and treat every glowing press release as a potential sales pitch, you'll avoid becoming the liquidity event for someone else's exit strategy. But if you insist on trusting numbers without questioning them, understand that you are the dream customer for every overhyped, over-leveraged company on the exchange. They don't need you to think. They just need you to believe. Key takeaway: numbers don't lie, but people using numbers often do. Treat reported earnings like the start of an investigation, not the end of it. Favorite quote: in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Picking your champions. Stock selection secrets. So let's talk about the dirty little secret nobody admits. Most people pick stocks the same way they pick fantasy football players. A gut feeling, a headline they read, or because their buddy at work swears this one's the next big thing. That's not investing. That's self-sabotage with a brokerage account. Graham wasn't trying to hand you a lottery ticket. He was trying to teach you that picking stocks is closer to casting the lead role in your life's most expensive movie. Get the wrong actor, the wrong business, and the whole production bombs. And guess who pays for it? You. Graham breaks it down into two camps. For the defensive investor, stock selection is boring on purpose. You're not looking for the next Tesla, you're looking for companies that make toothpaste, groceries, insurance, the kind of dull, predictable businesses that survive wars, recessions, and presidential tweets. The criteria are strict. Companies with a long history of paying dividends, stable earnings over at least a decade, manageable debt, and a price that doesn't assume they'll conquer Mars by next Thursday. Translation: you're betting on consistency, not fireworks. The enterprising investor, though, plays a different game. Here, you're allowed to hunt, but only if you know what you're hunting for. Bargain stocks trading below book value. Small companies overlooked because they're not glamorous enough for Wall Street's spotlight. Special situations where the market has overreacted, marking down a business because of a temporary stumble rather than a fatal flaw. The enterprising approach isn't about being reckless, it's about being patient and disciplined enough to dig where others won't bother. Graham's enterprising investor doesn't chase hype, they ambush it. Now here's the part people don't like. Both approaches require you to think for yourself, which is why so many avoid them. It's easier to follow the crowd, to buy Apple because everyone else has an iPhone, or to pile into AI stocks because CNBC can't stop repeating the word disruption. But crowds don't build wealth, they destroy it. Graham knew the real edge in stock selection wasn't IQ, it was temperament, the willingness to be bored when everyone else is excited and curious when everyone else is asleep. And here's the brutal truth. The reason most people suck at picking stocks isn't because the market is rigged, it's because they refuse to do the homework. They want six-pack abs without ever stepping into the gym. They want double-digit returns without reading a balance sheet. They want to look like Warren Buffett without actually having the patience of Warren Buffett. But the market doesn't reward entitlement, it rewards discipline. Graham's playbook filters out the noise and forces you to judge businesses the way you should judge people. Not by what they promise, but by what they consistently deliver. Picking a stock is like choosing a business partner. Would you hand over your life savings to someone with no track record, drowning in debt, who constantly makes excuses about one-time issues? Of course not. Yet people do exactly that in the stock market every day with a smile. Graham's system is your BS detector. It keeps you from falling in love with the story and makes you focus on the numbers, the history, the margin of safety. It's not glamorous, but neither is not going broke. The irony is, if you follow Graham's rules, you'll rarely be the person bragging at the bar about the hot stock that doubled last week, but you'll also never be the guy sheepishly explaining how he lost his kid's college fund betting on the next Amazon. Which life do you want? Key takeaway. Stock selection isn't about prediction, it's about discipline. Treat it like choosing a lifelong partner, not a weekend fling. Favorite quote: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. The fine print of fortune, special securities and hidden lessons. Most people treat the stock market like Tinder. Swipe right, hope for the best, and then act shocked when the perfect match ends up ghosting them. That's what happens when you dive into investing without reading the fine print. And Graham? He's that old friend who keeps telling you, hey, maybe stop falling for the same red flags. The market isn't just about common stocks, it's littered with exotic contracts, hybrid securities, and seductive promises that look like gold but crumble like cheap costume jewelry when the spotlight hits. Take convertible bonds and warrants. On paper, they sound like financial magic. You get fixed income security with the bonus option to convert into stock later, or a warrant that lets you buy stock at a set price. It's the market whispering, hey, you can have your cake and eat it too. But Graham saw through that pitch. The problem? These securities are designed to favor the issuer, not you. They're traps dressed as treasures, shiny distractions that let companies raise money cheaply while handing you a gamble in disguise. People buy them because they can't resist the thrill of the what if. What if the stock soars and I cash in big? But that what if mindset is just speculation in new packaging. It's Vegas in a tuxedo, and when Graham unpacks case histories, the actual stories of companies and their securities. It's not some boring financial history lesson. It's a highlight reel of people's greed and naivety being exposed. These are real-world reminders that markets punish blind optimism. Investors bought into inflated promises, misunderstood clauses, or trusted management teams that didn't deserve trust. Every one of those mistakes could have been avoided with patience, skepticism, and, let's be honest, the humility to admit you're not smarter than the market. Here's the uncomfortable truth. Most people lose money not because Wall Street is evil, but because they're lazy. They don't read the documents. They don't analyze the business. They want shortcuts, cheat codes, a way to get rich without sweating. And the market, like a predatory lender, loves that type. It dangles shiny securities with fine print designed to bleed you dry slowly. If you think you're immune, ask yourself, when was the last time you read past page 1 of a financial disclosure before buying stock? Exactly. That's why Graham was confrontational about these instruments. He wasn't saying never touch them. He was saying, don't touch them unless you actually know what you're doing. But here's the catch. Most people will never know what they're doing because they don't care to learn. They'll keep buying into hype, keep confusing speculation with investment, and keep blaming the system when they lose. The fine print is where fortunes are either protected or destroyed. Graham's lesson is brutal but liberating. If you can't understand it, don't buy it. Don't convince yourself you're sophisticated because you hold securities with names you can't even explain at a dinner table. Sophistication in investing isn't about complexity, it's about clarity. Simplicity is strength. Complexity is often just camouflage for risk you can't see until it's too late. Key takeaway: the market's exotic securities and case studies prove one thing. The devil is always in the details. If you don't have the patience to read and understand the fine print, the market will happily write your financial obituary. Favorite quote: to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. The final test: safety first, wealth second. People want to believe they're financial daredevils. They think stacking their portfolio with hot growth stocks and praying for 10x returns makes them bold visionaries. No, it just makes them gamblers with a Robinhood account and too much caffeine. Real courage in investing isn't about chasing the riskiest play. It's about protecting your money from yourself. That's the punch in the gut Benjamin Graham throws here. The market doesn't reward the bravest, it rewards the safest. And if that offends you, good, because chances are you've been confusing recklessness with strategy. When Graham compares pairs of companies, dividend policies, and finally drills into the concept of margin of safety, he's basically pulling your excuses apart one by one. He takes industries side by side, the flashy versus the steady, the hyped versus the boring, and proves that hype fades but fundamentals endure. The winners weren't the companies with the loudest projections. They were the ones that quietly delivered results. That's the kind of lesson that sounds boring until you realize it's the difference between retiring free and working until you're 80. And dividends? People ignore them because they're not sexy. Everyone wants the next Amazon or Tesla. Nobody brags about a stock that only pays out a reliable stream of cash year after year. But here's what Graham slaps you with. Those boring dividend checks often build more real wealth over time than all the moonshot bets combined. A dividend policy tells you whether a company respects its shareholders or just wants to keep fueling its own empire building. Companies that refuse to share profits with their owners while selling you on future growth often end up as case studies in delusion. The crown jewel of this whole section, though, is margin of safety. If you don't understand that, you don't understand investing, period. The idea is deceptively simple. Never buy a stock unless it's trading below its intrinsic value, giving you a buffer against error, bad luck, or plain stupidity. Why? Because you will make mistakes. You will misjudge companies. You will get caught in market storms. A margin of safety is your seatbelt, the thing that lets you walk away from crashes while everyone else is picking up their teeth. But most investors hate this idea because it requires patience. You can't brag about patience in a group chat. You can't screenshot your margin of safety, and that's why most people skip it and why most people lose. Graham's postscript hammers the nail even deeper. Wall Street is designed to make you overpay, overtrade, and overreact. Your defense isn't genius stock picking, it's discipline. The richest investors aren't the ones who called every market top and bottom. They're the ones who refuse to let emotion or ego override rational strategy. Safety first, wealth second, not the other way around. The uncomfortable truth here is that most people don't want safety. They want the illusion of control. They want to believe they've got a system that beats the market. But when the storm comes, it's not your system that saves you. It's your safety net. Graham forces you to admit this, and if that makes you defensive, it's because you're already investing without one. Key takeaway: wealth is built on safety, not risk. Protect yourself first, chase glory second, because there's no glory in bankruptcy court. Favorite quote: the essence of investment management is the management of risks, not the management of returns. The proof. Inside the minds of the market's master players. Here's where most people finally get their ego shattered. Up until now, maybe you've convinced yourself that you're different, that you'll beat the market because you're smarter, sharper, more disciplined. But then Benjamin Graham drags out Exhibit A, the super investors of Graham and Doddsville. Real people, real track records, investors who didn't just talk theory, they printed money for decades using the exact principles he's been hammering into your head. And here's the kicker: they all had different strategies, different industries, different timing, but one thing in common: they never betrayed the core ideas of value investing. Meanwhile, most of you betray your strategy the second Tesla dips 3%. These super investors weren't gamblers, they weren't day traders, they weren't addicted to CNBC soundbites. They were patient assassins. They didn't chase hype, they stalked value. Warren Buffett is the obvious headline name here, probably the most famous graduate of Graham's school, but he's not the exception, he's the proof. His track record doesn't scream genius, it screams discipline. And discipline is exactly what most of you don't have. Here's the uncomfortable truth. You think you're too smart for boring investments. You think buying undervalued companies and holding them feels too slow, too unsexy. So you chase whatever's trending. Crypto, meme stocks, AI startups, because you want to look clever. Meanwhile, the super investors quietly compounded their way to empires while you were busy refreshing Reddit. Graham's whole point is that superior returns don't come from innovation in investing style. They come from stubbornly applying the same principles long after everyone else got distracted. The data is ruthless. These investors consistently beat the market not by outsmarting it, but by refusing to play its games. They bought low, they demanded a margin of safety, and they waited. That's it. No magic formula, no secret Wall Street insider knowledge, just the discipline to act rational when everyone else acted insane. And that should piss you off, because it means the only thing standing between you and serious wealth is your own lack of self-control. People want to believe successful investors have some hidden gift, some sixth sense, but Graham dismantles that fantasy. The gift is patience, the edge is logic, the secret is ignoring everyone else. You don't like that answer because it means there's no shortcut, no hack. You can't download patience. You can't outsource discipline. You can't fake the courage to sit on your hands while everyone else is screaming buy or sell. That's why the few who can do it end up billionaires, while the rest end up with screenshots of portfolios they almost held onto. What's wild is that Graham is basically handing you the receipt book of proof. He's saying, look, here are the people who did it, here's how they did it, and here's why it worked. And if you're still skeptical after this, it's because deep down you don't want it to be true. Because if it's true, then it's your fault when you fail. Key takeaway: extraordinary results don't require extraordinary genius. They require ordinary principles applied with extraordinary discipline. Favorite quote: it is not necessary to do extraordinary things to get extraordinary results. The Taxman's playbook: winning the wealth game without losing to the IRS. The government doesn't need to rob you at gunpoint. It's already in your wallet every single paycheck. And the funniest part? Most of you don't even notice. You'll argue endlessly over whether some tech stock will go up 5%, but you'll hand 30% of your income to the IRS without blinking. Benjamin Graham, in his appendices, doesn't just talk about stocks and bonds. He pulls the curtain back on one of the biggest predators of wealth: taxes. And if you think the market is ruthless, wait until you see how the tax code treats the unprepared. Let's get brutally honest. The taxman doesn't care about your financial goals. He doesn't care if you're saving for a house or grinding your way toward retirement or just trying to escape living paycheck to paycheck. He takes his cut first. Before you invest, before you save, before you even breathe, Uncle Sam gets paid. And if you don't understand how taxes work, you are voluntarily walking into the ring with one hand tied behind your back. Graham lays out the framework for investors in the 1970s, and the lessons are still lethal today. Different types of income get taxed differently. Dividends, capital gains, ordinary income, they don't all land the same on your tax bill. And yet, most amateur investors treat them as equal. That ignorance alone can cost you tens of thousands of dollars over a lifetime. Imagine spending hours researching stocks, analyzing charts, reading financial reports, only to throw away half your gains because you didn't plan for the IRS. That's like running a marathon and then collapsing 1 foot from the finish line. The real kicker is capital gains. Hold a stock for less than a year, and the IRS treats your profits like a paycheck. Ordinary income, the worst rate. Hold it longer, and suddenly your tax bite drops. But here's where people sabotage themselves. They panic during volatility, they flip in and out of positions, and they feed the IRS more money than they feed their own portfolio. The lack of patience isn't just costing you in returns, it's literally feeding the machine that works against you. Graham's lesson is simple. Patience isn't just an investment strategy, it's a tax strategy. And let's talk about dividends. Everyone loves the idea of passive income. I'll just live off dividends. Sounds great until you realize dividends don't have the same tax advantage as long-term capital gains. You're being taxed every single year, even if you don't sell. That means a so-called safe dividend strategy might not be as efficient as you think if you're not playing it with tax rules in mind. You're not just collecting checks, you're collecting tax bills. Here's the confrontational truth. Most people don't fail at investing because the market is too hard. They fail because they're bleeding from invisible cuts. They chase short-term wins, ignore long-term tax implications, and then wonder why their portfolio doesn't grow. The government doesn't need to rig the stock market. Their edge is already built into the tax code. Graham is waving a red flag in your face. You don't just need to know how to invest, you need to know how to keep what you earn. If you're serious about building wealth, you've got two opponents, the market and the taxman. And the taxman is undefeated if you play by his rules without understanding them. Investors who win don't just think about return on investment, they think about after-tax return. That's the difference between the wealthy and the wannabe wealthy. The wealthy don't just make money, they keep it. Everyone else brags about gross returns while their net worth gets drained behind the scenes. Key takeaway. Wealth isn't about how much you make, it's about how much you keep. Understanding taxes isn't optional, it's the difference between compounding your gains and compounding your mistakes. Favorite quote, "The investor's chief problem, and even his worst enemy, is likely to be himself." The new Wild West, speculation, tech stocks, and high-stakes gambles. Picture this, you're scrolling through your phone at 2 a.m., eyes burning, hands shaking, and you see a headline, "This AI stock could be the next Amazon." You hit buy. Why? Because you're not investing, you're gambling. And worse, you're gambling in the Wild West of modern finance, where the sheriff left town decades ago. Benjamin Graham, decades before TikTok traders and crypto bros, already warned us that speculation would always seduce investors into believing they found a shortcut to riches. And here we are, proving him right, generation after generation. Graham dissected speculation long before it became dressed up in buzzwords like disruption, innovation, or the future of finance. He understood that speculation is intoxicating precisely because it feels like you're smarter than the rest of the crowd. You convince yourself you see something others don't. But the brutal truth, Most people aren't visionaries, they're victims. They aren't picking winners, they're buying into stories. Stories so seductive they'll drain your bank account before you realize the ending was already written. Look at the dot-com bubble. Look at 2008. Look at the crypto implosion of 2022. Every single time, investors swore this time was different. It never is. Graham would tell you, speculation isn't evil, but treating speculation like investment is financial suicide. If you want to speculate, fine, but set limits. Allocate a small portion of your money, the fun money, the same way you'd budget for Vegas. But here's where most of you blow it. You bet the rent money on meme stocks, you max out credit cards for the next Bitcoin, and then cry when reality reminds you that math doesn't care about your optimism. And then there's tech. The shiny, seductive world of infinite potential. Graham didn't live to see Facebook, Tesla, or Nvidia, but he didn't need to. He already understood the script. High-growth industries attract hype. Hype fuels overvaluation, and overvaluation guarantees heartbreak. Tech companies are especially dangerous because they have stories that sound unstoppable. Who doesn't want to believe in AI curing cancer or space travel becoming a weekend hobby? But Graham would grab you by the collar and ask, are you buying numbers or are you buying dreams? Because dreams don't pay dividends. Here's the ugly, confrontational truth. If you're chasing tech stocks because they're popular, you're not investing. You're buying lottery tickets with better branding. Most of you aren't analyzing balance sheets. You're repeating TikTok clips and parroting Reddit threads. You're throwing money at companies with zero profits and negative cash flow because you think the logo looks futuristic. Graham's method, dull, methodical analysis, sounds boring compared to hype, but boring pays. Exciting usually bankrupts. So what do? You separate speculation from investment. You treat speculation like entertainment, not wealth building. You demand a margin of safety even in tech. You don't just ask, how big could this get? You ask, what's already priced in? Because if the whole world knows a company will dominate AI, guess what? That dominance is already baked into the stock price. You're not early, you're late. You're not smarter than the market, you're food for it. The future is bright and it is dangerous, and yes, it can be insanely profitable. But Graham's voice cuts through the noise. The investor who survives isn't the one chasing the shiniest story. It's the one who knows the difference between a narrative and a number. Key takeaway. Speculation is inevitable, seductive, and sometimes even fun. But the second you confuse it with investing, you're done. The only defense is discipline. Set rules, separate gambling from strategy, and never mistake popularity for profitability. Favorite quote, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Conclusion. So here's the ugly truth. Most people will never get rich because they refuse to get honest. They want shortcuts. They want the dopamine hit of speculation. They want to look smart at dinner parties, bragging about their picks, while their portfolio quietly bleeds out. Graham didn't write The Intelligent Investor to give you hot tips or the next Amazon. He wrote it to hand you a weapon, a framework that doesn't care about fads, hashtags, or Wall Street marketing departments. A framework that says, protect your money, demand a margin of safety, and don't act like a clown when the crowd is losing its mind. Here's the punchline. The market is not your friend. The market doesn't care if you're a nice person. The market doesn't care if you have rent due or if you're betting the kids' college fund on some AI disruptor. The market punishes stupidity and rewards discipline, period. Graham gave us the playbook. Buffett took that playbook and turned it into billions. And yet, most of you will ignore it because it doesn't feel exciting enough. You'd rather chase a shiny story than learn to read a balance sheet, and that right there is why the market keeps minting victims. But if you've stuck with this breakdown, if you've let Graham's words collide with some uncomfortable truths, then you've already done more than 90% of people who claim they invest. And maybe that's your edge. Not being smarter, not being faster, not finding the next big thing, but simply refusing to play the wrong game. Here's the challenge. Stop pretending, stop speculating like a drunk in Vegas, and start investing with intelligence. Don't just parrot quotes from Buffett, actually live by the principles that made him untouchable. That's how you win. And yes, buy the book. Don't just take my word, don't just settle for summaries. Get your hands dirty with the real thing, because The Intelligent Investor isn't bedtime reading, it's a manual for survival in a world built to separate fools from their money.